Now let's talk about the co-op ownership model. If you're new to the electric co-op business, you know that you're a little different from a conventional business in that the members of the co-op own the co-op. And we call that patronage capital. And you are owned by the people that you serve. It's an interesting arrangement and it works quite well. There's co-ops across the country, about 800 of them, and they all follow this model. So, an electric co op is member owned. It's a not for profit organization, although there are situations where you will pay taxes depending on the makeup of your revenues. And we're not really going to get into that in this class, but for the most part, you're a not for profit organization. And every customer is an owner, and the co op's very existence is to provide a affordable, reliable electric service to all the members and not necessarily generate a profit. Although you should generate a profit to fund operations, capital improvements, and pay debt service as well. So the revenue that is generated by the co-op members is not just a payment for services, there's an investment component to it. So, in other words, when there's a profit, we call that margin in a particular year, the excess of that belongs to the members, not to the co op. And the way it's calculated is based on the kilowatt hours that the member uses of the co op's output for the year. So, you do have a margin which is akin to net income, and you use that to fund operations, repay debt, finance capital improvements, but eventually that net margin gets returned to the members who paid it in. So you have side records that have a listing for every member that you have had and currently have, and what their balance is of patronage capital. And so this is fundamentally different from an investor owned utility or a municipal utilities where these excess revenues become retained earnings in the business. Here, it's ownership and it's tracked as such. But co-ops finance their operations in traditional ways, just like investor-owned utilities and municipal utilities as well. Your your primary revenue source is from member payments for electricity usage. Your members are your customers are your members. So what you sell for electricity, customers pay for, and you use that as a revenue source. Other revenue sources include long-term debt financing. So you can borrow from the Rural Utilities Service. You can issue bonds through them. They come with a lot of requirements on maintaining certain coverages, how you use the monies, and things like that. And you can also issue revenue bonds out in the market outside of the RUS. Those also have requirements as well for certain earnings like debt service coverage, things like that. And then member equity, that cumulative margin that you build up over the years, really represents cash that you reinvest in the business. And this is the members' equity stake, again, recorded by individual members. So if you have 10,000 members, you have 10,000 records, 2,000, 2,000, like that. But it shows what the share is of the margins over the years for each particular member. So patronage capital is not profit, it's really member equity temporarily held by the co-op. And eventually there is an obligation to return it to members when cash flow permits, but following a board approved retirement schedule. And we'll talk about policies when it comes to member retirements as you go through the process and things to consider. And it's a co-op by co-op basis. And again, it's based on the available cash flow that you do have. So why RUS requirements shape co-op financial management? Well, if you have RUS debt, so you went to the Rural Utilities Service and you borrowed from their debt window rather, or took a loan from them, they have lending requirements that govern how you manage your finances, forms you have to file, equity ratios that you have to maintain, and things of that nature. And one of their key measures is the TIER ratio, the times interest earned ratio. And that requirement is 1.25. And what that means is for every dollar of bond principal and interest that you pay to the RUS, you have to generate at least $1.25 of net margin. So that's a key ratio that they focus on. And what that means is it impacts your rates and also your cash flows as well. And the RUS concern is that you pay back the RUS. So the first dollar you earn in a co-op goes to pay the RUS, or if you have revenue bonds, goes to pay those bondholders as well. And once you've paid those obligations, then you can run your business. Interesting way of doing it. Like they say, the borrower is slave to the lender. So that's definitely the case here. NRUS also expects the co-ops to maintain an equity ratio of 20%. That's equity divided by net assets, total assets. And the major component of that equity is patronage capital. So if you don't meet these RUS requirements in any one year, you might have restrictions on capital credit retirements or getting new monies from the RUS, or both. And the thing that drives all of this is cash flow. The thing that drives cash flow is mainly rates, expenses, capital expenditures, and debt service. So the bottom line is this: patronage capital is member money held in trust, not co-op profit. So the understanding of the co-op ownership model, that's the foundation for everything else in this course. So when members pay their electric bills, they pay for service and they also provide funds for investment. And those individual patronage capital accounts tracks that investment, and it's up to the co-op to have policies and procedures in place that manage that whole process from the investing side to the capital credit retirement side as well.